Warren Buffett just trimmed his BYD position by 17.7%. At the same time, the stock has surged over 60% since January and sits at an all-time high. So is Buffett just taking advantage of the higher price? Or is he seeing a danger that the market is missing? When we look at the recent financial results of BYD, the numbers are incredible. Revenue is up by 29% year over year. Earnings are up by 34%. Cash is down by 5.7%, but the debt is down by 31%. Such results can easily explain the rising price of the stock. But something made Buffett walk away from the table. So who is right? The Oracle of Omaha or Mr. Market? Today we are going to go through our 7-step analysis process to answer that question. We will see, is BYD winning with Tesla? What risks come with investing in this Chinese company? And we will value BYD to see if it could be a great investment or is it already too expensive. But first, let's take a look at some historical results. If you invested $1,000 in this company 10 years ago, you bought 201 shares. And today, they would be worth something close to $10,710. And this company also pays dividends, so in that time you would get $120 as dividends. So if we add together the current value of shares and the dividends, we get $10,830. And that is a gain of 983% in 10 years. That's an impressive performance. Actually, very impressive. Let's see who's benefiting from this growth. Individual insiders, that is a check. 30.1% of the company is owned by individual insiders. So that is great. We know that the management should take good care of shareholders because they themselves have significant skin in the game. And are individual insiders buying? That is an X. We don't see any transactions from insiders in the last year. And do super investors own this company? That is a check with one super investor, and it's none other than Warren Buffett. And is he buying right now? That is an X. Buffett actually sold 11.6 million shares last quarter. At least so far, he is trimming this position. He is realizing his gains, but he did not abandon this investment. So maybe he still believes there is more potential in this company. Well, let's take a look at some fundamentals to find out. Return on invested capital, that is an X at 3.8%, and we want to see this number higher than 10%, so that's disappointing. And what do we know about net profit margin? That is an X averaging 3.1% in the last 5 years, and the industry median is 3.2%. So BYD is basically somewhere in the middle when it comes to their margins. And now let's take a look at share buyback. It is also an X. They issued extra 20.5% of shares in the last 10 years. That's not what we want to see. This dilutes existing shareholders. But it's worth pointing out that in the last 2 years, they are actually buying back stock. And the debt, it is a check. It would take them just few months to pay the long-term debt with the current free cash flow. That is very good. All that does not look very appealing. But financial health is just one aspect of a company. While we aim for our companies to remain robust, we also want them to grow. Revenue growth, that is a check at 27.5%, and we would like to see this number higher than 10%, so that's very impressive. Free cash flow growth, that is an X, but the reason for that is that it was negative till 2019, so we can't really calculate it. But it's worth noting that since 2020, the growth was around 9%, which is decent. And earnings per share growth, that is a check at 51.5%. This is some exceptional growth that shows that the company is becoming more efficient over time because earnings are growing much faster than the revenue. Now, let's see what benefits we can get just for holding shares of this company. The dividend yield is 0.9%, so shareholders can expect to get 44 cents annually per every share. That's not a very high yield. And the payout ratio, that is a check at 27%. And we want to see the payout ratio somewhere between 20 and 50%. So this dividend appears to be very sustainable with enough earnings retained to fuel growth. And what about dividend growth? That is a check at 71.2%. That's extremely impressive. Though we should note that dividend history is not a story of steady growth. So we've established that BYD is growing rapidly, as are the dividends, and that could be a good reason for investing in it. But an investment only makes sense if we are not overpaying for it. Price to earnings ratio is 35.3. That is very high, especially compared to traditional automotive companies. To calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And if you would like to value companies by yourself, then just go to stockinvesting.academy and choose our company valuation course. So for this valuation, we are using a 5-year average free cash flow to smooth out cyclicality and to be more conservative because it is a Chinese company which comes with additional risk. So in the low scenario, we will estimate a growth of 12% for the first 5 years and then 10%. In the medium, 17% and then 14%, and in the high scenario, 22% and then 18% growth. So the low scenario is well below the predicted growth of the EV industry, which is around 17%. The medium scenario is in line with industry projections, and the high one is showing a story in which BYD is growing faster than its peers, closer to the growth we saw in the last years, but still slower. When it comes to buying BYD stock, it can be a little confusing because we have two versions of BYD stock in the US market, BYD-DF and BYD-DY. You can also buy it on the Hong Kong Stock Exchange and Shenzhen Stock Exchange. When it comes to the US, the main difference is that BYD-DY shares trade at twice the price of BYD-DF shares, and so they represent twice as many ordinary shares. But you can buy any of the stock versions because they represent the same company. In this valuation, we are looking at BYD-DF shares. So with our estimates, the intrinsic value in the low scenario is $40, in the medium $54, and in the high scenario, $75. Now, we must always apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the low scenario $28, in the medium $38, and in the high one $52. And the current price is around $53. So depending on the story you believe in, BYD is either expensive or not that far off its fair value. So what do we make of BYD as an investment opportunity? First, let's acknowledge the positives. Exceptional revenue and earnings growth, minimal debt with strong cash position, significant insider ownership, growing global expansion. But there are also risks to consider. Low return on invested capital and below average profit margins, long-term share dilution, and geopolitical risks of investing in Chinese companies. Now, let's open our Stock Ranking Pro and look at some historical data. We can see that BYD has dramatically accelerated its growth in recent years. Revenue has surged, free cash flow is positive, and after years of minimal earnings, we are now seeing significant growth in earnings per share and also in dividends. And let's compare BYD with Tesla. So let's filter the ranking to only see those two companies, and let's go to our scorecard. When it comes to investor sentiment, it is a draw. Dividend score, that is of course a win for BYD because Tesla does not pay any dividends. When it comes to growth, BYD is very strong, but Tesla is growing even faster. Financial health score, that is a draw, and when it comes to valuation, BYD is a bit cheaper. Overall, BYD gets a slightly better score, especially if we consider the valuation. But even with all the recent problems that Musk created for Tesla, this fight is far from over. It is also worth pointing out that BYD is expanding aggressively internationally with plans to build a third manufacturing plant in Europe on top of the existing facilities in Germany and Spain. The company is targeting expansion in Europe, South America, Asia, and Africa. So is BYD a buy at current prices? It really depends on which growth story you believe in. If you think BYD can continue to outperform the broader EV market and successfully expand globally, the current price offers reasonable value. If you are more conservative or concerned about the risks of investing in Chinese companies, you might want to wait for a better entry point. Thanks for watching and see you in the next one.